September 15th, 2008, 1:45 in the morning. A 158-year-old investment bank files for bankruptcy. $613 billion in debt. 25,000 employees walk out carrying boxes. Traders on Wall Street watch the Dow drop 504 points before lunch. By the end of the month, $11 trillion in American household wealth. Gone. This is the story of how your neighbor's mortgage almost ended the world. To understand 2008, you've got to go back to 1999. That year, Congress repealed a law called the Glass-Steagall Act. It had been around since 1933, created after the Great Depression to keep a wall between commercial banks, the ones holding your savings, and investment banks, the ones making risky bets on Wall Street. When that wall came down, banks could do both. Hold your deposits and gamble with them. And for a while, the gamble paid off. At the same time, the Federal Reserve had slashed interest rates to historic lows. Borrowing money was cheap. And the cheapest thing to borrow for? A house. So banks started lending. A lot. To almost anyone. Picture a family walking into a mortgage office. They earn $40,000 a year. On paper, they can't afford a $300,000 home. But the lender doesn't care. He offers them what's called a subprime mortgage, meaning a loan given to someone who likely can't pay it back under standard terms. The trick is something called an adjustable rate mortgage. The payments start low, sometimes just a few $100s a month, but after 2 or 3 years, the rate resets. Suddenly, that payment doubles, sometimes triples. The lender knows this, the family doesn't. In 2005, 43% of first-time homebuyers put zero down. The median down payment across all buyers? Just 2%. Banks weren't asking whether people could pay. They were asking how fast they could close. But the loans weren't staying with the banks. Now here's the thing nobody talks about. Banks didn't want to hold these risky mortgages, so they came up with a way to get rid of them. They bundled thousands of individual mortgages together into a financial product called a mortgage-backed security. It's exactly what it sounds like, a security, an investment, backed by mortgages. Investors around the world bought them, pension funds, insurance companies, foreign governments. Because credit rating agencies, the companies whose entire job is to evaluate risk, gave many of these bundles a AAA rating. That's the same rating as U.S. government bonds, the safest rating that exists. The problem? The mortgages inside weren't safe. They were subprime. But because they were mixed together, sliced into layers called tranches, basically tiers ranked from safest to riskiest, and wrapped in complex math, the risk was hidden. It was like taking rotten fruit, blending it with fresh fruit, and selling the smoothie as organic. And then Wall Street got creative. Wall Street created another layer. They took those mortgage-backed securities and repackaged them into something called a CDO, a collateralized debt obligation. Think of it as a smoothie made from other smoothies, each one more removed from the actual mortgages underneath, each one harder to evaluate. And then they created insurance on those CDOs, called credit default swaps. So now you had banks making loans they knew were risky, selling those loans to investors, rating agencies calling them safe, and other firms betting on whether or not they'd fail. Everyone was getting paid. The mortgage broker took a commission for closing the loan. The bank collected a fee for packaging it. The rating agency got paid to stamp it safe. And the investment fund? They sat back and collected returns. Nobody in that chain had any reason to ask whether the family could actually make the payments. The incentives were perfectly aligned, in the wrong direction. And everyone kept drinking. Stop and look at the full picture for a second. Families are in homes they can't afford. Banks are selling those risky loans to investors worldwide. Rating agencies are stamping them as safe. And everyone, from Wall Street to Main Street, is making money. Housing prices keep going up. Nobody asks what happens when they stop. That question gets answered in 2006. Home prices peak and begin to fall. Slowly, at first. Then, the adjustable rates start kicking in. Families who were paying $800 a month suddenly owe $2,000. They can't refinance because their home's now worth less than what they owe. A term for that is underwater, meaning you owe more on the mortgage than the house is worth. Defaults start climbing. By 2007, HSBC, one of the largest banks in the world, issues its first profit warning in 142 years, citing losses in its U.S. subprime division. New Century, the largest subprime lender in America, goes bankrupt in April of that year. The cracks are spreading, but the real collapse hasn't started yet. March 2008, Bear Stearns, the fifth largest investment bank in the country, collapses. The Federal Reserve brokers an emergency sale to J.P. Morgan Chase for $2 a share. Just 12 months earlier, those shares traded at $170. Then, September, and in a single week, the financial system comes apart. It starts on the 7th. The government seizes Fannie Mae and Freddie Mac, the two agencies that back most American mortgages. That alone would have been the biggest financial story of the decade. 8 days later, it's a footnote. September 15th, Lehman Brothers files for bankruptcy. Over $600 billion in assets, the largest corporate bankruptcy in United States history. The government decides not to bail them out. That decision sends a shockwave through every market on the planet. The very next day, the Federal Reserve takes over AIG, the insurance giant. Why? Because AIG had insured billions in mortgage-backed securities through credit default swaps. Think of it as selling insurance on a house you don't own, except the house is on fire and you've sold 1 million policies on it. The government commits $85 billion to keep AIG from dragging everything else down with it. Global stock markets lose more than $10 trillion in market value within weeks. And then came the fallout. Not on Wall Street, on your street. 8.7 million Americans lost their jobs. The unemployment rate doubled, hitting 10.2% by October 2009, the worst since 1983. Nearly 4 million families lost their homes to foreclosure. At the worst point, more than 1 in 4 American homes was underwater. The median household saw its net worth cut roughly in half, from around $107,000 to about $58,000. Think about that. A lifetime of saving, and half of it vanished in 18 months. Retirement accounts gutted, college funds emptied, and the damage wasn't distributed equally. Black and Hispanic families, who were disproportionately targeted for subprime loans, lost a far greater share of their wealth. In some communities, home values fell by more than 50%. Entire neighborhoods went dark. Rows of houses with foreclosure signs in the yard and nobody inside. Congress passed a $700 billion emergency bailout called the Troubled Asset Relief Program, essentially using taxpayer money to buy the toxic assets that banks couldn't sell. The Federal Reserve pumped trillions into the banking system, and in 2010, Congress passed the Dodd-Frank Act. It was the most sweeping set of financial regulations since the 1930s, built specifically to prevent banks from making the same bets that nearly brought the whole thing down. So, what does 2008 actually tell us? If someone hands you a financial product you don't understand, that's not sophistication. That's a red flag. The families who signed those mortgages weren't reckless. They trusted a system that was already rigged against them. AAA didn't mean safe. Government-backed didn't mean risk-free. Those were labels. And labels are only as honest as the people writing them. And financial crises? They don't appear out of nowhere. They're visible years in advance if you know what to look for. Easy money flooding in, prices climbing with no real reason, everybody winning, and nobody asking how. That's the setup, every time. So the next time someone tells you, this is a good investment, and the only evidence they offer is because it keeps going up, that's not an argument. That's the top of the cycle. Lehman Brothers survived the Civil War, 2 world wars, and the Great Depression. It didn't survive the loans your neighbor was sold on a Tuesday afternoon. The system recovered. The regulations changed. The psychology didn't. Next time, we look at what happens when the crash takes 6 hours instead of 6 months. October 19th, 1987, Black Monday.